Hi, everyone. We're going to get started. If you could please take your seats. Thanks for joining us. I'm Marisa Coggin. I'm a partner in the Corporate and Regulatory Insurance Group here at Dentons, and I have with me today Jacqueline Friedland from OSFI. Jackie's the Executive Director of Risk Assessment and the Intervention Hub in the supervision sector, and she leads the supervision teams for all FERFIs, or federally regulated financial institutions. Welcome, Jackie.
Thank you.
So no shortage of activity for OSFI in the past few years. We've seen a great degree of focus in particular on non-financial risks. We've had the introduction of the Integrity and Security Guideline. We've had refined expectations on third-party risk management, operational risk management and resilience, climate risk management, not to mention the introduction of a new supervisory framework. So I'm curious to know, how has that changed OSFI's approach? I know there's an increased level of communication and frequency with the market participants, and that can be presumably a good thing because you can assess your risk on a more frequent basis, on a thematic basis.
Okay, so first I'm going to apologize by saying that I'm going to read from my prepared remarks. I always do that when any of you have seen me speak. You know this is just the way I operate. It also gives me the benefit to make sure I stay on point and get the important messages I want to convey across. And also I've had a dozen colleagues from OSFI in climate, in operational risk, in approvals review my remarks to make sure that I do hit the important comments. So I'll answer your question in two parts. First, has the new framework changed our approach and our communications? And then are we seeing more fluctuation in ratings, which you had also indicated you were interested in? And before I answer either of those two questions, I should disclose that I was one of the executive change champions for the new framework, so I am very biased. I think it's brilliant. I spent much of last fall and winter and into the spring speaking to boards of directors and senior management at conferences one-on-one about the benefits of the new framework. And in my opinion, it has resulted in significant change. And while others, whether you're in OSFI or you're in industry, may not see that because we still do reviews, not investigations, but reviews. And we still ask for information, not to get you because we're curious. And we still, do monitoring, quarterly and year-end monitoring. So it may look the same, but I see things very different. And, where I sit with responsibility for SIB teams, the biggest banks and the small and medium-sized banks and the biggest insurers and the smallest insurers and all the pension plans, and I see it across all the rating categories, from 1 where we've identified no issues to 8 where we're going to take control. So I see that our interactions and our communications in person and in writing really have changed. We speak about what matters now. We are speaking about the so what. I've spent the last 14 months working at OSFI to make our communications more clear. So you really know, so what, why does it matter, in clear, easy to understand language. You don't have to be an expert in compliance risk management or technology risk management to understand the messages we're trying to convey. If we discover a shortcoming, and we often do, either through our monitoring or our review, the first thing we do under the new supervisory framework is we determine whether or not it's material. Because if it's not a threat to viability or it's not a threat to your operations, then it's not going to show up in our risk assessment in our new scorecard. And so in my opinion, the conversations have been so much richer since April 1. In our old framework, we conducted reviews that were driven by significant activities. And today, instead, our work is aligned with the 4 pillars of the framework. So there's business risk, financial resilience, operational resilience, and risk governance. And we talked about net risk and inherent risk and composite risk rating. And to be honest, I found all those terms really confusing. I spent most of my career in industry. I've only been with OSFI 4 years. I celebrated my anniversary last month. And I didn't understand the old framework. Everything about this new framework is coherent to me. And I was typing my prepared remarks on Monday on a plane back from Vancouver. I went to the Grey Cup, go Argonauts, it was great. And so I typed coherent, sitting there in my little seat, with a laptop on the desk, the airplane desk that was kind of wobbly. And then I used the word thesaurus to see if coherent was really what I intended. And coherent means, according to Word, intelligible, clear, comprehensible, and rational. And that's what I think the new supervisory framework is, and that's what I hope we are conveying in our communications with you. When I've spoken at conferences about the new framework, I talk about transparency and accountability. And that's our accountability to you, to the institutions, the banks, insurers, and pension plans that we supervise. In our letters, if we are communicating a rating of 3 or higher, we will communicate an outcome statement, a short statement that starts with an active verb of what you need to do or the state that we need to see the institution in to improve that rating. So to me, this is a huge change from what we used to do. We really want to be clear with you. Now, you had asked me in our exchange of emails about our ratings changing more often, and they absolutely are. Because I'm working on improving our writing, every supervisory letter comes through me. Maybe a pain point with some of the supervisors, but I think it's producing better documents for all of you. So I see the rating change letters. I see some go up, I see some come down. I see, because we have these 4 pillars, and within the pillars, there are white boxes. If you were part of our webinar last year where we were talking about the new supervisory scorecard, we will communicate when a rating changes, even if it doesn't change the overall risk rating. So you may already be at a 3 and your risk governance may change from 2 to a 3. We let you know that even if it doesn't change the overall risk rating. Again, we are erring on the side of complete transparency with you, so you don't have to guess what we're thinking. So those are my prepared comments on the framework.
No, that all makes sense. And I think, and speaking of transparency, OSFI has asked FERFIs for a lot of information over the past few years through the form, of questionnaires, consultations, things of that nature. So particularly on the INS side, on the integrity and security side, FERFIs had to send in the ISQ earlier this year. Then they had to develop an action plan stating how they would comply with the expectations in the guideline by 1/1/2025, more or less. There are a few that are after that. But what themes did you find emerged from all of that information that you collected? And was there anything that surprised you?
Okay, so I'm going to be careful in responding to this question because we are in the middle of developing our first report to the minister. And we didn't ask for the integrity and security, including national security mandate that was given to us by Parliament. And it came into effect very quickly. It was less than a year. We had to develop the guidance, set up a team, set up a new sector, hired a new assistant superintendent. And that team, the Integrity and Security Risk Division, has sequestered themselves for the last several months digesting all that information. So I saw a draft of the report to the minister a couple weeks ago. I'm now turning those into supervisory letters that will go out to every single institution that responded with their self-assessment with a combination of industry themes and institution-specific themes. So I've got to be careful in terms of not divulging before we have the respect to give it to the minister first. But a couple of things. Larger institutions, this won't be surprising. Larger institutions tend to be further along than smaller institutions in 3 ways. One, in the development of the policies and having processes in place that effectively action what's written in those policies, and then actually having internal audit do assessments of whether or not the policies are effective and the actions that they're doing are effective. So that shouldn't be surprising. An important point I want to leave you with today, it's not about just having a policy. That policy is a document, a piece of paper. Now it's a Word or PDF file. But having a policy, you have to effectively address what that policy is speaking about. You have to be able to address it day after day and year after year in a sustainable manner. And many of our outcome statements in our annual supervisory letters talk about that effective implementation of policies, and actioning it in a sustainable way. Second comment I'd want to address with integrity and security is a lot of what's behind the essence of integrity and security already exists in our current guidelines, especially as they relate to non-financial risk and those burdens that everyone likes to complain about that OSFI's done over the last few years, and our corporate governance expectations. These haven't changed. They've not really increased. It's with the change to our mandate. Third, almost every institution, regardless of its size, and this was an insight from the self-assessments, relies on third parties. Lots and lots of third parties. The smallest may rely on, the number may be 2 digits, and the big may be in the high 3 digits in terms of the number of third parties they rely on. Thus, institutions have to have policies and procedures, including business continuity and disaster recovery plans, that consider not only themselves, but the critical third parties that they rely on. And fourth and final comment is about proportionality. And I didn't have this in the version I wrote on Monday or even yesterday, but it got reviewed this morning by the Integrity and Security people, and they told me to add it. So at a recent internal meeting last Friday on integrity and security, our policy and legal teams shared their thoughts, and I'm going to read this exactly, that proportionality is not an exemption for institutions to not meet guideline expectations. Proportionality, this is really important, allows for risk-based approaches to the sophistication of solutions, but it is not a reason to not establish policies and frameworks. So I think that's really important. To the extent that a branch sets up a small operation in Canada, it's not an excuse that it's just a small branch with a small portfolio and it doesn't have a big direct written premium component. And if it's a branch of a big international firm, you're going to have these policies and procedures most likely somewhere else. Certainly England is going to ask for them. Australia, APRA is going to ask for them. Switzerland's going to ask for them. The US is going to ask for them. So you borrow off of those and you Canadianize them. That's what we're asking for. We're not asking you to create something from scratch. So those are my 4 comments that I can share right now.
Okay, that's great. I appreciate that. And we'll be looking for that report once it comes out. I want to talk a bit more about business continuity and business continuity plans in particular, and sort of the focus on operational risk management and resilience in 2025, given the updates to E21. So what are the gaps that you're seeing, if any, on the business continuity side, given that that is such an important key feature for operational resilience? There are other tools, of course, but that is a very important one.
Okay, so one of our areas of focus in 2025 will be on business continuity management, as this has an outsized impact on an institution's operational resilience. And I think some of the most significant gaps that we've seen in business continuity and disaster recovery plans are related to the lack of meaningful testing. And it's through real life examples and meaningful testing, simulations, tabletops, et cetera, with disruptions that are prolonged. Not a short one, but a prolonged one, that an institution can learn what works and what doesn't work. And I'll share something. I've spoken about this many times over the last month. I had the pleasure of attending the AM Best conference. I don't know if any of you did. It was like a month ago or 6 weeks ago. They come once a year and they talk about Canadian life and P&C insurers. And I was particularly interested in the remarks of one of the Quebec-based insurers. And he spoke about the summer floods, and it started that he was at a tennis tournament and he was waiting for the match to begin, and then the skies opened. I can't remember whether that was Friday night or Saturday night. And then he talked about arriving at the office on Monday morning, and there were 16,000 voicemail messages. They received the equivalent of 4 months worth of claims in a very, very short day. He spoke about how their business continuity and disaster recovery plans were not fit for purpose. They didn't have enough laptops for all the extra people they brought in. They did not have enough cell phones for everybody that they brought in. They had to go to the Quebec regulator to ask for disposition on some of the licensing. And, this was a real life simulation with real life consequences for the insurer and the insurer's customers. So they lived through it. They'll do lessons learned. They'll, all of these plans will be better the next time. But so I ask you, have you run meaningful simulations or had meaningful real life examples where you were able to test your plans and learn from them? How resilient have you been when there have been disruptions? How severe or prolonged were you? And remember, again, consider yourself and the third party.
I think that's really helpful and very practical and commercial advice. One of OSFI's mandates is to ensure that FERPs remain in sound financial condition and generally to promote the stability of the Canadian financial system. So, we've talked a lot about climate today. We've talked a lot about cyber risk, geopolitical risk, all sorts of things that have happened over the past couple of years, along with the surge in inflation and rapidly evolving technologies, including AI, of course. So how should FERPs be thinking about operational risk in the context of what you could call economic uncertainty at this stage?
Okay. So how you presented that question just now is a little bit different than what I got in the email and my prepared remarks, but hopefully I'll get at it. Okay, so it's a very complex world we're living in right now. We see it daily in our professional roles. We see it personally in our own lives and the lives around us. And I'm always amazed by the discussions around our holiday dinner table, particularly Thanksgiving, as my grown kids come home from university and their friends, from high school come over and we talk about what's happening in their lives. And so each one, and this I'm talking about economic and technology shifts. So each one of my 3 sons is now using generative AI for different purposes. One uses it to debug software. He's a mechanical engineering student, and he uses it for, classes. He's also now using it in his co-op job because they're giving him things he doesn't know how to do, and so he looks at Gen AI. My other son is using it in law school to help summarize briefs and cases. One used it last spring to put the finishing touches on his LSE application, which he got into. And last week he used it to help him with his R course, which he's struggling with a little bit. And then he submitted an op-ed piece to the New York Times, and he used it to help put the finishing touches on that. So, going back to the exact words of the question as I had it, how should institutions be thinking about operational risk management and operational resilience in the context of economic uncertainty and rapid changes in technology? The risk-averse risk manager in me, thinks, how can institutions protect themselves and their customers in these times of economic, geopolitical, technological, climate uncertainty? Rapid changes are introducing new risks and threats. It's important that risk management frameworks cover identification and management of risks. These frameworks require constant updating. They should be dynamic and commensurate with the risk and the threat landscape. You need policies, you need procedures, you need governance, you need the checks and balances to ensure you can deliver through disruption on your commitments to customers and your commitments to stakeholders. You need systems and controls to protect your customers' data. You need systems and controls to protect your employees. And a lot of this is part of what's integrity and security. There's like 10 principles of it, and one of them's physical, about protecting, your premises and your employees in those premises. As I sat on the plane on Monday, I thought of the New York Times article I recently read about young Black men and women getting targeted emails on the day after the U.S. elections. And then just this week, young LGBTQ and Latino men and women getting targeted emails. And I think, whose data was breached? Their names were perfect, first and last name, their email contact was perfect. Insurers have so much data on their clients, and I am not insinuating that it was insurers that breached the information to this, but it just makes me think about vulnerabilities and threats and risks that we never thought of, we never imagined. Who would imagine people getting these kind of horrific emails? And so how should institutions think about operational risk management and operational resilience? They need to stay ever focused, ever alert, ever diligent. They need to be agile and act with urgency. They can't rest on their laurels because they survived the CrowdStrike event this summer, because they may not, survive the next one or have no impact the next one. You need to do root cause analyses when you have a problem, and you need to do root cause analyses when you actually passed one without a problem to see what were the controls that helped you avoid it. And you need to do this, my last comment, whether you're large or small, as both large and small institutions are subject to risk and operational loss events. And this is where questions of proportionality become difficult, because yes, large institutions have more risks, but larger institutions also tend to have more expert people to help them and bigger budgets to hire the experts. So I turn the question on you. How do you, those of you who are from smaller institutions, ensure that you have the right resources to protect your institution, your customers, and your stakeholders?
And many of the institutions that we act for tend to be those smaller foreign branches. We do have obviously domestic clients as well that have more built out teams, but on proportionality, what kind of advice would you give to a branch that is trying to identify key risks within that context that you were speaking about?
So I'm going to go off script for a minute, and then I'll come back to my script. So, Jordan made a really good point in the first session today that you may outsource some of your services, but you can't outsource your compliance and your ultimate responsibility. If you want to operate in Canada as a federally regulated financial institution, you need to be aware of the requirements of both legislation and regulation, guidelines and others, and regulatory notices. While we do apply proportionality in our expectations, there are foundational elements that we expect with respect to policies, processes, controls, corporate governance, etc. And given the complexity of the world we live in, it's not an easy task to ensure the systems, protocols, and all these things address business risk, financial resilience, operational resilience, and risk governance. Just think of those 4 pillars of our new supervisory framework. Becoming a federally regulated financial institution is not a simple process, and remaining a federally regulated financial institutions with ratings that I expect senior management and the board, if it's not a branch, would find acceptable is not a simple task either. So my advice, which is what you asked for, is go in with your eyes wide open of what it really means to operate sustainably as a FERFI, and do not think that just because you're small, expectations will be minimal. They absolutely will not be. Well,
okay, thank you for that. Shifting to guideline B10. So that has been in effect since earlier this year in May, and foreign branches are also expected to adhere to it by the end of Q1 2025. One very common type of arrangement in the insurance world is the relationship between insurers and MGAs. Those relationships have existed for quite some time. And OSFI earlier this year conducted a thematic assessment on MGAs. And I believe it was the annual risk outlook that cited the rationale for that being a change in the business risk associated with those arrangements. So I'm curious as to what the specific change in risk was from OSFI's perspective.
Okay. So I have a long answer to this one. I don't know if any of you were at the PASIC Risk Officers Forum this spring, maybe not. So I'm going to use some of my speaking remarks from there. I'm going to repeat. So MGAs made it to my radar late spring of 2023. And I should state that I'm a P&C actuary by background. That's what I did for almost 40 years. Joining OSFI 4 years ago was the first time that I'm not acting in an actuarial role. So it's been a real learning and growing experience for me. But anyway, in the spring of 2023, I attended an in-person concurrent session at the annual conference of the Canadian Institute of Actuaries. And I'm going to try to paint a picture of this scene for you. One of the speakers was the executive director of the Canadian Association of MGAs, and he was so excited to speak about all the wonderful things Canadian MGAs were doing, and the growth, the tremendous growth of MGAs in Canada. Now, this particular conference attracts very few P&C actuaries, though this was a P&C concurrent session, and it was in Halifax, so even fewer actuaries went. So we were in a big room like this, but there were about 15 or 20 of us in there. And I was sitting in the front row next to Erica Schur, who's the chief actuary of Travelers, and Michelle Dion, chief actuary of Aviva. And none of us are shrinking violets. And like as soon as the gentleman started speaking, we're like just throwing questions and throwing opinions at him. And, I laugh, somewhat embarrassed by how we maybe hijacked that session. But it sunk in me in a way that it never had before what MGAs are doing. They're developing products. They are pricing products. They are marketing products. They are underwriting products. They are issuing and servicing products and policyholders, and they are providing claim services on products. So essentially, they are holding the pen on many of an insurance company's most critical functions. However, they're not an insurer. They don't have capital that an insurer has. They're not accountable to legislative or regulatory requirements of OSFI as insurers are. They're not required to have the strong governance processes that we expect of insurers. And I get concerned, or they write in, custom tailored manuscript policies that may not even be, have the reinsurance that I listened to this session on legal trends and the additional insureds or the named insureds or the are they doing something with wording that could end up putting an insurer at risk? Are they going to the quarterly pricing committee that's part of governance? Is all their information flowing through from a reserving committee perspective? So given that our mandate is to protect policy holders, I sat at that conference with an entirely new perspective, and I immediately emailed Daryl Ledbetter, who at the time was our only the senior director with an insurance portfolio. Now we have two, and I'm like, we have to do something on MGAs. We got to do it right away. And then a couple weeks later, I sat at our family cottage, and I'm writing the whole plan for the review, which we didn't do for a little while. I didn't realize at the time that FSRA was also interested, and there's another big Canadian provincial regulator that was also interested in MGAs. So it was making a lot of us concerns were rising. So, I'll skip the part of my prepared remarks where I talk about the growth in MGAs. I mean, it's been tremendous. It's double digits. Where there used to be a handful of companies that used MGAs, it's now well over 70. It is, when I did my research in the fall of 23, I think it was 10% of the Canadian market. When I did it again in 24, it was 20% of the market. People expected could grow to 50% of the market. So I am concerned. I get it from a niche perspective. When my children were younger in high school and they wanted to play competitive hockey, I actually helped start the Toronto Non-Contact Hockey League. This is before the GTHL went non-contact with some of their select and some of their lower levels of A. I needed an MGA to help us get directors and officers insurance because I was on that board of directors. So I get the value personally of an MGA. But we need the right governance procedures in place of the insurers who use them. So that was my concern.
So in terms of the partnership between the MGA and the insurers, when you're reviewing the insurers' third-party risk management protocols and procedures, presumably you're looking at audit, you're looking at diligence.
The MGA relationship can affect the entire scorecard. It can be your business risk, your business model, how good you are at planning, how are they integrated into that. It can affect the financial resilience, and is it being considered properly in the reserving and the pricing, all the protocols around that. It can the operational resilience from all the third party, and then the risk governance. Is there internal audit of those important MGA relationships?
That all makes sense. So on climate, and as a former actuarial guru, and she's written 2 textbooks actually on actuarial matters, climate risk is one that is very heavily reliant on actuarial analysis. It underscores all the risks on the ORR scorecard. It's a transverse risk. The standardized climate scenario exercise. So market participants have to submit that either in December or January, depending on the module. Given that exercise is still in its infancy, and I think that the superintendent said at a recent conference in the fall that they expect there will be tweaks to how they conduct this exercise and the inputs that are required because OSFI is still learning as well as we go. How soon do you expect OSFI would be in a position to assess risk on an individual FERFI basis?
Okay, so there are a number of comments I want to make, some on script, some off script on climate. So we will continue to grow, learn, and evolve. I was at the annual meeting we had with the Insurance Bureau of Canada and the superintendent and some of the assistant superintendents this spring, and there was some pushback. I don't know if I'm supposed to say this in front of everyone. I know there's no media in the room, on the climate regulatory return. And the superintendent, said it won't be perfect at first. The data won't be perfect. But if we don't start somewhere, we're not going to get better. So, it's the internationally active insurance groups who have to do it first, and the SIBs, the systemically important banks, and then the other insurers will do it, and banks the next year. There was a comment about the climate regulatory burden in Canada going ahead of other jurisdictions. That's not true. I sit at the International Association of Insurance Supervisors Executive Committee. I hear what others are doing. The climate returns that are going to be due in the U.S. are incredibly onerous. So I actually think ours aren't as bad. There's a lot about climate risk that we can actually assess today that falls within these 4 pillars, and I'm going to use an example. And I've used this internally when we were talking about where does climate go on the scorecard, and this goes back a year and a half ago, and I remember exactly where I was in Ottawa, sitting in the room talking with the different people involved with the framework. I said, I see it affecting every pillar, and I use this example. Consider a mutual insurer, a small mutual insurer that operates in a single province. It can be an Atlantic province, it could be Alberta, it could be BC. In every province, in every quarter of the year, we have exposure to Nat Cat kind of risks. And assume this small insurer only does one or two major lines of business, which could be property and auto, both also exposed to the Nat Cat kind of risks. With the climate risk, or climate lens, I'll look at the pillars. So business risk. This particular example has a business model with risk concentration, both from a geographic and a product line. Thus, there's a significantly limited diversification benefit. And depending on the province, climate risk could be flood, pluvial, fluvial, hurricane, convective wind, hail, ice storm, fire. And the supervisory team would ask how the institution's business model would fare in a climate event. Does that contribute or detract from its soundness? Also, how strong is it in its planning? Financial resilience. The financial resilience pillar includes assessments for insurance risk, which includes cat risk, capital adequacy and management, liquidity adequacy and management, investment risk, and asset liability management. Given the increasing frequency and severity of cat events, we heard about that earlier today, the supervisory team would consider the strength of the institution's current reinsurance program, as well as potential impact of changes which could be driven by global events or market or local events. We would consider the capital and liquidity considerations of a major climate event to this particular institution. Would also consider the fact that it was a mutual and what is its access to capital. And operational resilience. We would consider the adequacy and robustness of the institution's business continuity and recovery plans. We would look at not just what's on paper, what's been tested. We would look at how a climate event could impact operations, would consider alternatives that the institution may have identified and the reasonableness of this. And with respect to risk governance, the far right of our scorecard would consider how is it reflected climate risk in lines 1, 2, and 3. Would investigate any work that the risk team or the internal audit team has done related to climate. Are there any open issues or recommendations? Would look at the board's involvement. Are they leaning in? Are they engaged on climate risk? So even before Stefan Tardif's team, the climate risk division, does anything, especially for P&C insurance, I can see implications on every supervisory rating, all 4 pillars of climate. What's next on climate? So Stefan and his team will analyze the scenarios. They'll start analyzing the data that comes in from the regulatory return. He wanted me to add just this morning, he said, to add that guideline B15, which we updated in March to align with IFRS S2, will undergo another update in early 25 to align with the forthcoming climate disclosure standards from the Canadian Sustainability Standards Board. We're not going out ahead of them, is my understanding. And we expect our expectations about climate to remain highly aligned with international standards. So that was an important message.
That's helpful, and that's good news. So my last formal question before we open the floor for questions is looking to the future. Obviously, we have a few guidelines that are coming into effect in 2025, but what else is on deck for OSFI in 2025?
So I think our Assistant Superintendent, Tolga Yalkin, who I think the news was just made public, will be the new BCFSA Chief Executive Officer, which is wonderful for him. Sad for us. I feel like it's a privilege having learned from him. He's a brilliant, brilliant man. He's been very open that, we produced a lot, right, in a relatively short period of time. We were playing catch up a little with other jurisdictions, with things that were coming out of Basel and the IAIS. So, I don't see a lot new on the horizon. We have the regulatory notice on culture that's coming out. I have an email about it sitting in my cell phone that I got when I was here. And we'll also be very deliberate in these quarterly releases. So we have, I think, an upcoming date where we'll talk about, what's on the horizon. And we're just trying to be much more organized and deliberate in how we're releasing things and how we're engaging with you to help allow you to better plan during the year. So I think that's an important step that we're taking. Also, we're decommissioning some things that we feel like don't have relevance. I think Tolga's talked about that and Peter as well, the superintendent, pretty openly. Things that are dated and stale and not relevant, like we've done the low-hanging fruit. We've been able to identify a number of them. It's double digits, and we'll be decommissioning those. And then we'll start a more deep dive process in what else can be decommissioned.
And you're hosting an industry day, right, in the new year?
Yes. And we will continue to do our risk management seminar. We've done it for the last 2 years in June, where we combine banks and insurers of all sizes and type within, we have a couple of sessions that are for everybody, typically, technology risk, operational risk, climate risk, artificial intelligence, things that are applicable to all. And then we also have breakout. Actually, last year we had artificial intelligence as a breakout, but it was the only breakout we had at both sessions because we knew it would be so popular. Wow.
Fair enough. Okay, thank you for that. I will open the floor for questions.
Just going back to climate, you talked about the exercise, the SESC said it will improve over time. My understanding it's a one-time exercise. Is that not the case? Will this be an ongoing exercise?
So I think our supervision of climate risk will improve over time. So that's really what I mean. The data we ask for, we did a scenario exercise with some of the largest institutions, some of the IAIGs and the SIBs. I hate using acronyms, but it's a mouthful to say the other. I think you all know what I mean. We did that a few years ago and published that with the Bank of Canada, the results. Now we're doing it across, all the institutions. Is this going to be the last climate scenario? I doubt it. Will we do it every year? No. I mean, we've already, we've communicated to a group of actuaries in our actuarial advisory group what our next standardized stress and scenario test. I can tell you all here, we're putting the final touches on the document. It will focus on reinsurance. We will ask both life and P&C insurers to look at the largest loss they've had in the last 5 years and then assume failure of their largest reinsurer and report on those in the same way you do for your FCT, so the regulatory returns, which is your balance sheet, your income statement, your MCT or LICAT, and then assume the failure of your second largest. So we want to see both. It's not that we're assuming that this is necessarily a plausible scenario, but we really want to see what both the micro and macro prudential risks are if there was a significant reinsurance event. And given the continuing frequency and severity of climate events around the world, we think that's important to look at. So. And in coming up with that standardized stress test, we reached out to colleagues in regulatory authorities across the world, from Hong Kong to Australia to the UK, et cetera. So we're pleased with this, but it's not necessarily a climate event next year.
Does that include internal retrocession, internal reinsurance arrangements?
Yes, I believe it does, and registered and unregistered. I mean, it will be significant. 2 years ago, we did a standardized stress test that was macroeconomics, and it had assumptions about bonds, fixed income and equities and inflation, all that, and it was big and it was messy, and we understand from appointed actuaries it was difficult to run. This should be very easy to run. There is nothing unusual about this that's outside of the realm of your FCT. Like, all you got to do is you run the loss, and then you assume a reinsurance doesn't recover, so more is on your bottom line. So it's not a lot of extra modeling or extra work. If you have consulting actuaries, they shouldn't charge you a whole lot. I didn't say that. But it should be a relatively easy one to produce. And the exercise will be, what do you do with that information? What do boards and senior management, what would they do if they were faced in that situation? And that we'll be interested in as well.
All right. Well, thank you so much, Jacqueline. This was immensely helpful and insightful.
My pleasure.
So I just wanted to thank Jackie and Marisa again for a really riveting session and very informative, Jackie. I think you've scared everybody, all the smaller branches. So as we are now closing this incredible day, our first annual, which means we will be hosting another one next year, and we hope you all can attend. And we will be inviting FSRA and OSFI back to update us all again. We value your feedback, and there will be posted, sorry, this lost my footing. There will be posted on the screen and outside a QR code for comments and questions and feedback. That's really important because this was our first. We're looking for ways to improve and to make sure your needs are being met as our valued clients. So thank you all again for attending, and thanks to all our speakers and sharing in this day with us. Thank you.